Okay, so thanks, guys. This is the third in our series. Here we're going to talk about, we're going to finish up what we talked about the last class, and then we're going to go into working capital and maybe start getting into the balance sheet. So just, I promised, based on the feedback from the last one, that I won't get into from the last series. In these series, I'm focusing less on the concepts, more direct to the modeling, and breaking it up into shorter segments. I do want to talk about deferred taxes because I had a lot of questions, and I think we left it kind of, sort of hanging. So, we left, just to give you an idea as to where we were, we left off with the depreciation schedule and really talking about straight line depreciation versus accelerated depreciation and how that creates a deferred tax liability. So, from a mechanical perspective, just note that this is often the way it's done in models, where you would first of all build a straight line depreciation schedule, you would then build an accelerating depreciation schedule, and then you would calculate deferred taxes by subtracting accelerated minus straight line times the tax rate. And a lot of people don't know why that is. So I mentioned it briefly, but I want to talk about it and get into a little bit more detail. So just deferred taxes or deferred tax liabilities are created from timing differences and how financial reports are recognized, the GAAP version versus tax purposes. So companies will file public financial statements following the general accepted accounting principle rule, the GAAP rules, and then you'd file another set of returns for tax purposes. And they could be different. There could be different rules that you would follow when filing GAAP reports versus tax reports. And an ideal example of that is the ability to change the method of depreciation when filing GAAP reports versus tax reports. So what I mean is you can file depreciation using one specific method for GAAP and then do it in a different way for tax purposes. Those differences cause a deferred tax liability. Let me show you what I mean. So on this next page, I'm going to try to zoom in a little bit. Okay. The Control Plus usually works, but I'm in slideshow mode, so I guess it's not working. But what this is showing is these are two income statements. The left side is an income statement for GAAP purposes. Okay, and if you look here, there's revenue of $10,000. You have cost of goods sold, gross profit, etc. EBITDA is $5,000. The right column is an income statement for tax purposes, and we have revenue and we have costs, leading us to EBITDA of $5,000. Nothing's different. The income for GAAP purposes is filed publicly. So if you were a stock investor, you would see this information. The tax purposes is private. Okay. What we've done here, though, is we illustrated the impact of differing depreciation. So let's say for GAAP purposes, we're allowed to straight line depreciation. Straight line means depreciating the asset evenly over time. So straight line means, in this example, we have $1,500 in depreciation each year. On the right side, for tax purposes, we've accelerated depreciation. What's the benefit of accelerated depreciation? Well, there's a couple reasons why we mentioned last week why someone would choose to accelerate depreciation. One of them being creating a deferred tax liability. Accelerated depreciation basically means greater expense in the early years, less expense in the later years. Right? So in this example, with accelerated depreciation, we have now a greater depreciation expense. What does that mean? Well, if you have a greater expense, you have less taxable income. So here there's a benefit. There's a benefit for, first of all, showing a lesser expense for GAAP purposes, which shows higher net income. Let's say it shows higher net income, higher EPS for your shareholders. It shows that you're more profitable. And for tax purposes, though, you're showing a different method of depreciation, an accelerated depreciation, showing effectively a greater depreciation expense, which, means less net income, but it's less taxes. So what happens is, even though you're expensing $1,400 in taxes, you're really only paying $500. So that difference becomes a deferred tax liability, basically saying, we've expensed $1,400, but we're only going to pay $500 for tax purposes, which means you're not avoiding those taxes. You're going to have to pay them at some point later, and that gets recorded as a deferred tax liability. But the thing is this. For modeling, you don't build two income statements. So what this box on the right is trying to illustrate is the difference in depreciation calculation. This income tax expense saved, this $900 in deferred taxes, which is the difference between the tax expense and the tax paid, can also be calculated, well, you can calculate it by subtracting the taxes, but if you don't have two income statements, the other way to calculate this 900 is by subtracting the depreciations, accelerated minus straight line is 2250 times the tax rate. So my point is this page is supposed to illustrate the reason why subtracting depreciations and multiplying by the tax rate actually works. And it's important to know that because oftentimes you're asked that question in interviews. So I want just to kind of open up today by illustrating that. And as you recall, what we're trying to do, if you want to step back, is we've built the income statement, we're constructing the cash flow statement, and now our point is to finish the cash flow statement, we want to start building out the supporting schedules. So we built out the depreciation schedule. That gave us depreciation and deferred taxes. And now let's look at the working capital schedule. So the working capital is a measure of current assets and current liabilities. And for modeling purposes, again, to not focus too much more on the concepts, for modeling purposes, we focus on a narrower version of working capital, namely called operating working capital. Operating working capital is working capital or current assets, not including cash, and current liabilities, not including liabilities. And so what we do is, so the working capital schedule actually serves as a bridge between the balance sheet and the cash flow statement. It keeps the continuity going of these specific line items, the current assets not including cash and the current liabilities not including debt. They bridge from the balance sheet into this area of the cash flow statement, which is the other area of the cash and operating activities called changes in operating working capital. So we project the line items here, and we pull them into the cash flow statement, and then we can use the cash flow statement to drive our balance sheet. So this is what we do. So first of all, let's look at the historicals. We're going to look at the historicals like we do with any expense. This isn't an expense, but like we do with any other expense. And we will calculate historical metrics that we will use to make our projections. So here are the working capital items that we've identified: accounts receivables, inventory, prepaid expenses. There's other zero. We're just going to make this zero. Liabilities, accounts payable, and accrued salaries. Okay. We want to look at these line items and track them, calculate some metrics that will allow us to make good projections. And the way we do that is by comparing these items to operating items. Working capital is operating in a sense. Each working capital line item can be somewhat related to an operating line item. For example, accounts receivable. Accounts receivable is the revenue that we did not yet collect from the customer. If you've booked revenue, you may have received that revenue in cash, or you may not have received that revenue in cash. If you didn't receive that revenue in cash yet, that becomes accounts receivable. So accounts receivable is very much related to revenue. So the way that we look at projecting accounts receivable is by first tracking it historically, and we track it against the revenue. And we use a measure called days. We use a measure called days. The implication of days is how many days this accounts receivable has been left outstanding. How do we use the measure of days? Well, let's talk about how to calculate it. And to calculate it, we take the accounts receivable, we compare it to the revenue. We compare it by actually just divide it. So for example, accounts receivable divided by revenue is basically a percentage of how much of the revenue is accounts receivable, right? You're taking accounts receivable divided by revenue. And then we multiply that percentage by the number of days in the year, which gives us an implied value of how many days those receivables have been outstanding. But now, oftentimes for modeling, even though there's 365 days in a year, we actually use 360 more often than not, because 360 is a number that's easily divisible by 12. If you did 365, then you have to make adjustments for February and things like that if you happen to be converting from a yearly model into a monthly model. So for that reason, oftentimes, when doing modeling, we don't use 365 days, we use 360 days, because if we ever want to break this out into months or quarters, 360 is easily divisible by 12. But there's no right or wrong way if you choose 360 versus 365. Just you want to pick one way for your model and be consistent. So in this case, again, for example, let me give you another example. If, let's say, a company has revenue of 100,000. Company has 100,000 in revenue, okay? And let's say we've generated 25,000 in accounts receivables. Okay, that means 25% of our revenue is accounts receivable. Of all the revenue that we booked in a year, 25% we still did not get from our customer. 25% is still left outstanding. So we multiply that by the number of days, 360. That gives us 90. Sorry, I did the wrong thing here. I was supposed to multiply this. I just was on the wrong cell. By 360, this basically says 90. The implication is 90 days. The implication is in a year, 90 days of our revenue are still left outstanding. 90 days it is still left outstanding within a year, which another way to imply that is it takes 90 days for a customer to pay us, to collect on our receivables. So the way we calculate that here is we take the accounts receivable divided by revenue times 360. Memorize that formula better if you actually understand it. Accounts receivable divided by revenue times 360. Now, one quick note, because of the nature of balance sheets, because balance sheet information is a given point in time, okay, whereas income statement information is a measure of what's been accumulated over a period, balance sheet information is at a specific point in time. In other words, 2010, this means year-end 2010, we had 1350 in accounts receivables. I don't know what that means in terms of what's been generating or accumulating during the year. Income statement is different. Income statement, if it says 100,000, that means we've generated 100,000 within a year. This could mean I had $1 billion a month ago and lost it. I don't know, and because of that, this number can get skewed. In other words, at the beginning of the year, I could have had 0, and I built 1350. I could have had 10 billion, and it dropped to 1350. For that reason, when calculating this formula, for balance sheet only, we take the average. We take the average balance sheet balance divided by revenue times 360. That's the formula. So we're going to take average equals average. Everyone can do this now. We take equals average, open parentheses. Again, I'm trying hard to not get into concepts too much. If you want more, you're going to have to read the book, Financial Modeling and Evaluation. But working capital, in order for this to be not too systematic, I want you to have some understanding. So I'm talking a little bit about the concepts. Average E7, comma, the year before, close parentheses, divided by, so it's the accounts receivable, divided by, click over to the income statement. Go to 2010 revenue. Oops, I'm in operating expense. 2010 revenue times 360, okay? 41.7. I'm going to hit F2, look at that formula again, take a second, replicate it. The average of 2010, 2009, divided by 2010 revenue, times 360. We obviously can't do 2009 days because we don't have 2008. Okay? Now, we can copy this formula to the right one time only. Now, I've given you, the model already had days in there. I'm going to overwrite them. So what this is basically saying is that the company's days are 41, 42, pretty consistent. That's pretty close. I'm going to assume 42.4 days going forward. I'm going to overwrite that, 42.4. Now, another way to make projections, some people often ask in the class, I could do equal the year before, right? But you know what, for our purposes, let's just type in 42.4. If you did equal, you might get different numbers because I'm sure this is not actually 42.4. It might be 42.4336551 or whatever. Okay? Now the question is, how do I make my projections with that? We want to reverse engineer the formula that I just discussed. And if you want to know the algebra behind it, it's in the book. What reverse engineering this formula basically says, now remember what the formula does. The formula basically gives you a percentage, right? The receivables divided by revenue is a percentage times 360. When we're doing it this way, we want to get accounts receivable. We want to basically back into that percentage again, by taking 42.4 divided by 360. That backs into the percentage. Multiply the percentage by the revenue. So to reverse engineer, it's actually a little bit easier. We're going to do equals 42.4 divided by 360, okay, times the revenue. Okay? Copy that to the right. We're going to do this each time. Start to get familiar with that pattern and formula. Okay? We repeat this down. Okay? Okay. Inventory. Same idea. Inventory divided by X. We'll talk about X in a second. Times 360. Accounts receivable is related to revenue. Inventory is not related to revenue. Inventory is related to cost of goods sold. So we're going to do inventory divided by cost of goods sold times 360. Okay? But we're going to remember doing the average. We're going to take the average, open parentheses, this year's inventory, comma last year's, divided by income statement, revenue, times 360. Okay, sorry. Whoa, I did something wrong. I'm sorry. It's not divided by revenue. It's divided by cost of goods sold. I'm sorry. I'm going to do that again. Excuse me. Average, open parentheses, this year, comma last year, okay, divided by income statement, cost of goods sold in 2010, times 360. Okay? And you can copy that formula to the right. And this is basically giving you 33.7 days. And so let's use 33.7 days. And I'm going to reverse engineer this formula by taking the days divided by 360 times cost of goods sold. Okay, that's what you should be getting. And so on. Okay, just kind of pausing a little bit, give you time to kind of work that out. And I will give a longer pause to give you guys time. A little bit later. Okay, prepaid expenses. Now, prepaid expenses is related to some sort of operating expense. And the question is, what operating expense is it related to? You often don't know. And if this is a real company, you still might not know, but what you could do in a real company is you can kind of do a word search in the annual report for prepaid expenses and see what the expense is that they're prepaying. If it's rent, for example, you'll know it's SG&A. If you don't know, if you've done your research and you still don't know, the safest bet is just to take the total operating expenses. Let's do that. I'm going to take the average, open parentheses, this year's prepaid expenses, comma last year's, divided by income statement, total operating expenses, times 360. Okay, copy to the right. That gives us about 1718. I'm going to use 17.9. Copy to the right. Okay. I'm surprised that's the same number. I wonder if I accidentally had overwritten that. If I had recently overwritten that, please somebody let me know. I'm surprised I kept that number flat. Okay. If nobody's letting me know, then if for some reason you have a different number here, change it to 129 so we're all on the same page. I then want to reverse engineer this formula, the 17.9 divided by 360 times prepaid expenses. Sorry, times operating expenses. Copy that to the right. Okay. I'm also just other current assets are zeros. I'm just going to copy that to the right. And then to total the current assets, I'm just going to add up all these line items. You can't just do a big sum because you do not want the metrics tied into your total number. Okay, so what I'm going to do is I'm going to stop there. I'm going to give like a quick 5-minute pause. I want everyone online to try to catch up as best as possible. If you want to look into some formulas, send me a message and I'll open up that formula so you can look into it. I'm going to give a 5-minute pause so you guys can catch up. All right, so just continuing on. So now we're at the current liabilities section, and it's the same idea as the assets. Each of these relate to some operating line item. Accounts payable always relates to cost of goods sold. So where you have accounts receivable relates to revenue, inventory relates to cost of goods sold, prepaid expenses is some expense. We took total expenses if you're unsure. Accounts payable is related to cost of goods sold. So we're going to take the average, accounts payable this year and last year, divided by income statement cost of goods sold times 360. Okay, copy to the right. This gave us 16.9. We can use 16.9 and reverse engineer. So we're going to do 16.9 divided by cost of goods sold. Sorry, 16.9 divided by 360 times cost of goods sold. Copy to the right. Okay. Okay. Accrued salaries and employee benefits. This is like prepaid expenses, right? There's some expense that is accruing and will come due at some point, or, sorry, is due and hasn't been paid. This expense, though, we know. Salaries, employee benefits. So of the operating expenses, it's not research and development, it's SG&A. So we're going to base this off of SG&A, okay? So we're going to take an average this year and last year, okay, divided by income statement, SG&A, times 360. Okay, that gave us 39.8. We're going to use 39.8, and we're going to reverse engineer. 39.8 divided by 360 times SG&A. Okay? Copy this to the right. Add total current liabilities. Okay? I'm going to pause for a minute or two so you guys can get caught up here. Okay? All right, guys, so total working capital is the difference. It's the assets minus the liabilities. Don't add them. A lot of people end up adding them for some reason. The total working capital is the assets minus the liabilities. Okay? And the change in working capital is the year-over-year change. Right? This year minus last year. Right? This is the change. Okay, now there's a match here, which is a very important match I'm going to talk about in a second. There are several matches in these models, as you will see, that help ensure that the flow and continuity that you're building is going in the right direction, that you're not making mistakes. It's obviously not going to avoid all mistakes, but it will avoid some of the major ones. I want to talk about transferring this into the cash flow statement. This is basically balance sheet information. accounts receivable, inventory. The cash flow statement represents the year-over-year changes, okay? For example, changes in accounts receivable, changes in inventory. And I want to talk a little bit about how these changes impact cash flows. So for liabilities, let's start with liabilities because it's easier to think about. If liabilities, let's think about a loan. If there's a positive change, if liabilities are going up, you are generating cash. Think about a loan. If you were to borrow money, you'd get money, you'd get cash if you borrow money. You also get a liability. Now, if a company were to borrow money, cash would go up, liabilities go up. So if a liability goes up, that means cash goes up. If liability goes down, obviously the opposite happens. If liability is going down, you're spending money. Think about paying down debt. If you're paying down debt, liability goes down, cash goes down. Okay? Assets are different. And if an asset goes up, that means cash is going out. Remember, if liability goes up, cash goes up. If asset goes up, cash is going down. And think about buying an asset. If you buy an asset, you spend money to get the asset. Cash down, asset up. Right? Think about selling an asset for the opposite. If you're selling an asset, okay, the asset goes down, asset goes away, cash comes up. Okay, so there's an opposite movement. So in other words, if I see accounts receivable going up, that means actually cash is going out. Okay, so when transferring this into the cash flow statement, you need to consider the cash flows. So if AR is going up, I want to represent this as a cash outflow. Okay? So I want to show this as not, when I move this into the cash flow statement, I don't want to show this as the difference between 2012 and 2011, but negative the difference. Because if it's going up, I want to show as cash going out. So the way I'm going to do this, I'm going to say negative, in parentheses, minus parentheses, 2012, minus 2011. I could have just subtracted backwards, too. As negative. And that makes sense. Accounts receivable is going up, cash going out. Okay? Copy this to the right. Changes in inventory, same thing. Negative from the balance, working capital. 2012 minus 2011. Okay? Copy to the right. Changes in prepaid expenses. Funny that it's 0. I almost think that I've overwritten something. But okay, no, maybe it is. Okay, you actually know that matches because obviously there's no change here. I just don't remember that happening. Okay, so it's negative, open parentheses, 2012 minus 2011. Up to the right. Change in other current assets, even though it's 0, just for practice. Negative 2012 minus 2011. Okay? And for liabilities, it's the opposite. Right? For liabilities, because an increase in a liability means cash going up, it's a direct change. No minus the change. Okay? So for accounts payable, it's going to be just equal to no minus, it's 2012 minus 2011. For accrued salaries, it's accrued salaries, 2012 minus 2011. Other current liabilities, 2012 minus 2011. Okay? Take this whole thing, copy to the right. I'm going to give you a minute or two. Take a look at that, and then we'll discuss the conclusion. Okay? And I'm going to talk about this match. All right. So let's look at the working capital. Now, the idea of this match, now you can talk about the match and what it means. The idea of this match is it gives us the, it's designed to make sure that our working capital flows, our change in total operating working capital, matches the working capital on the cash flow statement. And it avoids a couple of very common mistakes. One, mismatching these line items with the lines in the operating working capital. In other words, either excluding one of these line items or including maybe an extra one. This happens a lot. And more importantly, making sure our flows are going the right way. Because the idea of subtracting backwards is something that a lot of analysts overlook. Or maybe you subtract backwards and then you copy this down, or you do something wrong. The match ensures that that's functional. And the way it works is it's checking for change in total operating working capital and making sure they match, because change in total operating working capital is being calculated in two different ways. Here, we're taking the total working capital and we're subtracting the total. Here, we're taking the individual subtractions, the differences between each individual line item, and adding the differences. That should come up to be the same number. Again, we're calculating change in operating working capital two different ways. Here, we're taking the differences of each line item and adding the differences. Here, we're totaling and subtracting the totals. Two different ways of calculating change in total operating working capital. Now, it doesn't match. It doesn't match because of one very important reason. This change in total operating working capital is meant to match the cash flow changes in total working capital. So this isn't meant to show the balance sheet change, but the cash flow change. So my question is, the question I'm going to answer is, this is supposed to represent the cash impact on the change in total working capital. So my question is, what is the cash impact on the total working capital? In other words, working capital from 2011 to 2012 is going up. So does that represent cash inflow or cash outflow? If the total working capital goes up, does cash go up or does cash go down? And that's a kind of tough question to ask unless you realize that working capital is the assets minus the liabilities, as you know, or working capital here is effectively a net asset. It's a net asset. So the total working capital acts like an asset. So if I see working capital going up, this should represent a cash outflow. And so the reason why this isn't matching yet is because what we were supposed to do was not subtract year over year, but do minus the subtraction, because we're treating this like an asset. And I didn't explain that as we were calculating this because you didn't know it yet. So when I go in here and I do, I'm going to readjust the formula to be minus, in parentheses, this year minus last year, or I could subtract backwards, and I copy this to the right, then it's going to match. So here, this is supposed to represent the change in total operating working capital, the cash impact on the change. Okay? And it matches. So it's a great way to prove that your working capital is linking properly. So now let's sit back and see where we're at. So we have a full income statement. One thing missing, interest expense. We have a full cash flow statement now. One thing missing, debt schedule. But we have enough to start to use the cash flow statement to build the balance sheet. Okay? So we're going to build the balance sheet. Once we build the balance sheet, we're pretty much almost done except for one final schedule, the debt schedule. Okay? And the debt schedule serves as a very important bridge, holding the whole model together, mainly linking interest expense and interest income into the income statement, and issuances and retirements into the cash flow statement. So we'll talk about that. Let's quickly look at the structure of the balance sheet. Again, I'm not going to go through too many concepts, but the balance sheet consists of assets, liabilities, and shareholders' equity. And there's a formula that must always hold in a balance sheet. The formula is your assets minus your liabilities must always equal the shareholder's equity, or you just do algebra, shareholders' equity plus liabilities must always equal total assets. And the difficulty in building and projecting a balance sheet is we're going to have to project each of these line items independently and do so in such a way that will keep this balance sheet balancing, that will keep that formula constant, that formula, we're going to project each individual line item in such a way such that this formula where assets minus liabilities equals shareholders' equity still holds. And the idea of building this and having your model fall out of balance is a common problem that an analyst has. And if anyone's read any of my books, I have a foolproof way of solving an unbalanced balance sheet. I don't know why it's taught often everywhere it should be, because I've seen at Morgan Stanley analysts staying up all night trying to solve unbalanced balance sheets. I've seen models being passed around for years with a 0.002 difference, and people can't figure it out. With this method, you can do anything in 30 minutes. I guarantee you there's no other way. If you just think about the concepts, the way I'm teaching this with the proper concepts in mind, there's no way you will be able to not balance a balance sheet within 30 minutes. And some of you guys are online that have taken my course know it. So what I first want to do is, let's just build out the historicals, and I want to just build out the total current assets by adding everything together to sum. Okay. The long-term assets, total assets, is the sum of everything. Is the sum of the current and non-current. So just take the total current assets and sum everything underneath it. I wouldn't do more than that. Sum up the liabilities. And the total liabilities is, don't forget to include the current liabilities, is the current liabilities plus everything else. And then sum up the stockholders' equity. And as per the formula, the sum of the stockholders' equity and the liabilities should equal the assets. And that's in balance. Okay. So next week I want to talk about how to project this and do it in such a way that keeps the balance sheet balancing. And I want to talk about the technique to solve it. So this is an ideal stopping point. If anyone has any questions, let me know, and we'll take it from there.